Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 169. Today is 25th of January. And our topic for discussion today is about the markets, whether we should worry about what's happening in the markets. Yesterday on 24th of January, we saw a dramatic fall in pretty much all global markets, started from the Asian markets where Hang Seng and Chinese stocks were falling hard, and then the Indian market fell down. Most of the segments in the market went down 3 to 5%, and in the evening we saw Nasdaq fall almost 4.5-5% before recovering most of the gains. Several stocks recovered there. It does not seem like, or at least we cannot say yet, that the fall is over. Yes, there is a pause at this point. Whether we will go deeper and the trend downwards will continue for some more time, or we will make a intermediate bottom and climb up back from here, is to be seen. We really nobody really can forecast what is going to happen. So, those who claim that they can forecast and they can front run the market are sort of misleading most people. What can be seen here is that the FIIs have been continuously selling, so more than 3,000 crores of selling yesterday, and on the domestic institutions have not been buying as much. Earlier they were matching the sales of the FIIs. Now the domestic institutions seem to be curbing their hand on the buy side. So there is a net institutional sale that is happening, and that is why the market is behaving the way it is. But today, Nifty made a sort of a smart recovery from the bottom, which was nearly 300 points down, and it closed at plus 0.8%. Bank Nifty was much stronger at plus 0.2.1%. And some of the sectors like PSU banks were very strong. So PSU banks rallied 4.2%, erasing all the losses of yesterday. Autos were very strong. Private banking was also strong. Public sector enterprises in general was strong. Realty came back. So this is a bounce, whether it's a dead cat bounce that we will again sell into post tomorrow's holiday, or we may just stabilize here waiting for the outcome of the budget, which is next week on 1st of February, is to be seen. IT sector has been the worst hit in the last 1 week at minus 8.9%, and the real estate sector was the second worst hit at minus 6.4%, and the others at nearly minus 4% odd so far. In terms of the broader indices, there was some gain between 0.75% to 1% on most indices, but my gut feel is that this is just a bounce, and this gains may not be durable. Weekend investing small cases also bounced 0.5% to almost 3% in the various portfolios, but I am not sure if this bounce is going to last too long. The reason is that unless the flows start to be positive, there may be a reason for further weakness, because in case the FIIs keep selling and the domestic institutions are not buying, then once we've seen several days of these numbers, the public also begins to doubt the investing that they're doing. And we have a very big event coming up in terms of the budget. A lot of positions may be getting squared up ahead of that event. There are, of course, rumors of all kinds of additional hike in taxes, and these are just rumors on long-term capital gains, etc. And they come every year. So, we should take it with a pinch of salt that these rumors will always be there around budget, and until and unless we see it in black and white, we really cannot believe anything. So given this state of affairs, let's also take a look at whether we should really worry about the market. So again, I would say it largely depends upon your approach to the markets. If you are a longer term investor who is coming in gradually bringing in the capital, I don't think there is anything, so dramatic that has happened that you should be worrying about it. Yes, if you are caught in leverage, if you have, done some averaging down in certain stocks that have been collapsing without a plan, without a strategy, then yes, of course, there is reason to worry there. But if you have been, sipping, or if you have been holding on to your strategy, whether momentum strategy or any other strategy, and you are doing well in the last couple of years, there is no reason to worry. We've come a long way since the COVID crash, and that kind of a run cannot keep continuing forever. So there will be pauses, there will be corrections, and the pendulum of the market will swing from one side to the other, from undervaluation to overvaluation, from under ownership to over ownership. So that dynamic of the market will always be there. However good the situation may be, however good the results may be, however good the fund flows may be, but that dynamic will always remain. So in terms of the market valuation, though I don't really pay any heed to market valuations, but because a lot of people who are watching may be doing so, you can see that over the last couple of decades, there have been regions where the market was actually very cheap. Just look at these 2002, 2003, 2004 levels, where markets were actually 11, 12, 13 for on forward PE. And as we have come into this last decade, actually the colors should have been the opposite, but thanks to Nifty PE ratio for this chart, but it gives the inverse meaning. We've seen forward P's go up to 40, and now it has cooled off to 24.8, which is not so bad. In the previous decade, forward earnings at 25 used to be extremely high. In the current decade, the historical benchmark seem to be changing, and 25 is not so bad anymore. So from that perspective, we've not seen PE ratio, forward PE ratios go below 20 in the last 7 years now. So 20 is maybe 10-15% away. So from that perspective, we are not like totally over the in some alien territory in terms of valuation, etc. This is another sort of 200-year, 130-year sort of chart, where all kinds of market events are listed. This is for the Dow Jones, from World War I to World War II to all kinds of great financial crisis, all kinds of bombings, this, that. You can see that there are blips along the way, and in earlier part of this last century, we saw recovery times used to be very, very high. 20 years of drawdown, 16 years of drawdown, 25 years drawdown. That has shrunk a lot in the last 40-50 years, since there has been capital on tap available. And the worst scenario that we have seen was after great financial crisis for 6 years time to come back to a new high. So from that perspective, the recovery periods has been shrinking, and we saw in COVID times also, the recovery happened within 3-4 months. The entire losses were regained. So from history, we can say that if you stick around, the recoveries may not be as long as what we are seeing here in the earlier part of the chart, but any kind of crisis thrown at the market has been well absorbed, and the markets kind of moves on. So the underlying markets need to be robust, underlying growth need to be robust, and if that is there, then the markets kind of take care of themselves always. And there's a lot of fear psychosis in the market that keeps happening, because of which we get these pendulum like moves all the time. Let me show you a chart of the Nifty. I've just plotted the daily chart on the Nifty, and this is the 200 DMA. You can see that over the last 7-8 years, and even if we go much earlier than that, Nifty keeps, going and meeting the 200 DMA every year and a half, every 6 months, sort of, pretty frequently. You can, if you go back even 2 decades, 3 decades. So 200 DMA is a very, very good indication of, where the excesses somewhat are taken out. So we are seeing here in the current scenario also, Nifty is very, very close to the 200 DMA at 16,600. So a large part of, the recent excesses have been taken off. So, below, once it does get below 200 DMA, if it does, those will be historically good areas to, to invest for, at least for the longer term. Yes, there can be periods of, 6 months, 9 months, 1 year where it can stay below the 200 DMA, but not too very long. Even after the great financial crisis, you can see, maybe Feb 2008 till about May 2009. So about 14 months it was below the 200 DMA, but then it took off. So, these are good indications that, but if we see on a very longer term basis, on a weekly basis, let's say, then let's say on a 200 week moving average, which is a very, very slow moving average, we have seen that we have overshot this by a long margin here. And the 200 week moving average is at 12,600. So this, you can say, would be, really, really bad situation when it happens, like it happened in 2008 or like it happened in 2020. Then the chart returns to this kind of an average. Otherwise, it probably, does not easily come back to this average. So, worst case scenario sort of is maybe like 30% below. Good case scenario is maybe like 3-4% below. So, from perspective of gradually bringing in money, making sure that your underlying strategy is self-correcting in nature and you don't get bogged down by, stocks which don't perform. Over time, you will perform well. The history is there in front of you. India is a growing market. The indexes take care of themselves by, new stocks coming in. The momentum strategies take care of themselves by shunning the poor performing stocks and bringing new stocks in. In short term, yes, there may be some pain. We may see drawdowns in short term, but over a medium to long term, you can see that, it's a very, very self-correcting mechanism. So as long as you have an underlying strategy and plan that kind of self-corrects, I doubt if there is much to worry about. So this is all that a small message that I had for, especially for youngsters who may have not seen a bear market before or may not have seen a 5-10% drop here or there. There's not much to worry about. Yes, we are still in in a territory which is not normal. So we are in extended territory, and that is true globally. So if there is a sort of a global crisis like 2008 or 2020, yes, we will lose ground. There is no doubt about it. But you keep your powder dry and, you keep adding to your strategy, and very soon, you will see that you will be able to ride this out. So with this, I want to end this today's daily bite. I wish you all a very happy Republic Day for tomorrow, and I'll see you on the other side. Thanks. Bye.